Ladies and gentlemen, welcome to the inaugural ForexSpace.com Roundtable. And what a stellar lineup we have. Joining us via Skype, Yoni Asay, founder and CEO of eToro.com. Then we have Kathleen Brooks, Research Director at Forex.com. Brendan Callan, President of European Operations at FXCM. Michael Dirks, Chief Strategist, FxPro. James Hughes, Senior Market Analyst at Alpari UK. And finally, we have Camilla Reid, freelance markets journalist and independent TV producer. We have a fascinating subject to discuss. According to a recent survey of fund managers carried out recently by Merrill Lynch, the US Fiscal Cliff is the issue that keeps them awake at night. I guess it causes a fair amount of insomnia among their clients as well. Mostly, however, it's giving Washington the jitters. Ben Bernanke briefed members of Congress last week after declaring he didn't think the Fed's tools would be strong enough to offset the effects of such a major fiscal shock as the upcoming cliff. With just over a month of electioneering left in the US presidential campaign, mounting concerns around the cliff are set by Barclays Capital to have now pulled ahead of the euro crisis as the top risk event in the minds of market participants. Dating back to the Bush era, intended as a way out of a deadlock over raising the US debt ceiling, the fiscal cliff will amount to the greatest US tax increase in history and the greatest reduction in the history of federal spending on the other hand. And it will be reached come the end of this year, presenting lawmakers with a stark choice. Either they let current policy go into effect at the beginning of 2013, or they can cancel or delay some or all of it, which would add to the deficit and increase the odds that the United States would face a crisis similar to that of the Eurozone. In summing up the fiscal cliff's estimated $1.5 trillion drag on the US economy, I'd like to quote Minnesota economist Tom Stinson, who said falling off the fiscal cliff would be roughly equivalent of going to bed on December the 31st with gasoline prices at $3.85 a gallon, then waking up the next morning with gas at $10.35 a gallon. So with all this in mind, we should be in for a lively discussion this morning as to what we might expect of the markets and how to make the best of the trading opportunities as the situation develops. We have a fascinating subject to discuss. According to a recent survey of fund managers carried out by Merrill Lynch, the US fiscal cliff is the issue that keeps them awake at night. And I guess it causes a fair amount of insomnia among their clients as well. Mostly, however, it's giving Washington the jitters. Ben Bernanke briefed members of Congress last week after declaring he didn't think the Fed's tools would be strong enough to offset the effects of such a major fiscal shock as the cliff. With just over a month of electioneering left in the US presidential campaign, mounting concerns around the cliff are said by Barclays Capital to have now pulled ahead of the euro crisis as a top risk event in the minds of market participants. Dating back to the Bush era, intended as a way out of a deadlock over raising the US debt ceiling, the fiscal cliff will amount to the greatest US tax increase in history on the one hand, and the greatest reduction in the history of federal spending on the other. And it will be reached come the end of this year, presenting lawmakers with a stark choice. Either they let current policy go into effect at the beginning of 2013, or they can cancel or delay some or all of it, which would add to the deficit and increase the odds that the United States would face a similar crisis to that of the Eurozone. In summing up the fiscal cliff's estimated $1.5 trillion drag on the US economy, so perhaps we could just start off with a general question. Do we think this has been priced into the markets already? Kathleen?
No, I don't think so. Because I think it's very difficult to try and foresee what will the outcome be. Also, I think with the fiscal cliff, there's kind of two issues. One's a short-term issue and one's a much longer-term issue regarding sustainability of finances, getting deficit on track in the US, etc. So no, I absolutely don't think so. I think the markets, I always think, tend to focus on one thing. That one thing has largely been Europe, and I think most people don't expect us to get to that edge for them to sort it out. So I think in that sense, people have you know, I don't see the S&P at 1450 odd. If they had any sense of what the impact could be next year.
I agree. I think it would be impossible to price it in now because there's a million ways this could play out. So I think there's a bit of wait and see, and I think she makes a good point. I don't think we'd be at 5-year and the NASDAQ side 12-year highs if people gave this due respect. So no, I don't think it's priced in quite yet.
Yoni, how about yourself? Do you think, do you agree with what Kathleen and Brendan have said so far?
I think, we should separate the bond market and the equities market. Equities market today are at all, reaching all-time high, which are obviously not really pricing any cliff or any danger at all-time high. While bond market, I think, represents more the macro fear. We see zero yields on the US dollar, and we see a policy that says this is here, zero interest is here to stay. And I think zero interest is here to stay, reminds a lot of people of Japan in the 90s, which basically says there is, a pricing of this fear or this understanding of an economical shift in bond yields. And it's interesting to see, I think, that the US, unlike, I think, any other country, is fueling its equities market and really saying that the equities market and the equities prices are what matters and not necessarily GDP growth or any other parameter.
Thank you, Yoni. What do you think about that, Camilla?
I think I certainly agree with with some of that, and the Japanese point is very interesting as well. I think that would certainly, if the market does hone in on that, that's going to make it even more depressed than it's starting to be at the moment, and you can certainly see that shift going on. I think, as Kathleen says, it's not around the fiscal cliff at the moment, and you can see that on the commodities markets and how they're playing out. We wouldn't have oil at 110, we've gone down already today, but it's nothing to do with that type of impression.
And Michael, what are your thoughts about it?
It's a very complicated issue, quite clearly. The first observation I'd make is that as an issue, it is actually relatively well understood. The fact that fund managers have essentially got it at the top of their sort of pecking order in terms of concerns, and that it's overtaken the euro and, interestingly enough, China as the major issue that they're focusing on is of interest in and of itself. That said, so I think that there's a degree to which the market has done two things. Firstly, it's recognising that the issue is, if you like, an ever-present danger as we zero in towards the end of the year. But at the same time, the market's also thinking, and investors are thinking, that ultimately some sort of deal will be done. And I think we probably all think that. At the same time, you cannot underestimate the incredibly fractious nature of dialogue between the two major parties. Just to put that into context, they're about to vote through a 6-month stopgap spending bill, which the House has passed, but the Senate has not just yet, but arguably will do probably within the next day or two. That sort of funds them until the end of March.
But that would have been unthinkable for them not to do that right on the cusp of a presidential election. It would have meant.
Well, here's the interesting thing.
Right,
They've not
Parliament
up to this point, and we're in the last week of the fiscal year in America. Not one of the 12 spending bills that has been presented to Congress has been passed. So we're in a situation where the two sides are at unbelievable loggerheads. So that is also pretty well understood, much better understood in America, I think, than it is perhaps in Europe. So, as Brendan was saying, there are just so many different ways in which there might be a solution to this, but I kind of come back to this central point, which is that the deficit at the end of this current year will probably be around the high 7s, perhaps a little bit under 8%. If the fiscal cliff is enacted unchanged, we end up with supposedly a deficit next year of around 4%. So that is a massive cut in anyone's language, and everyone would be keen to avoid that. And the rating agencies, in a funny sort of way, would never want to see that either. So what I think we're all hoping for, and probably will happen eventually, but again, how we get there is the interesting thing. You probably want something more like 6%. That's kind of in. You just want a sensible medium-term plan that still ultimately delivers debt reduction down the line.
Yes. Yes. Great.
James.
James.
But no, I mean, I totally agree with Mike when we say that this is now at the forefront of everyone's minds. It does show how understood an issue it is. But I mean, the comparison to having something like it creating a Eurozone sort of issue is scary, because the biggest issue that we have in terms of the Eurozone is that absolutely no one has any idea how to solve that problem. And I think this is going to be the same sort of issue. It's an unprecedented issue if we come to that. Now, I agree with Michael again that I don't think we'll get to a point where this actually happens. And as we well know, and as has happened before, parties will be at loggerheads for however long, and then we'll run right up to the deadline and something will be done, and I'm sure that would be the case. But if we were to tip over that edge, it is an unprecedented issue that like the Eurozone, no official, nobody knows how to solve it. And the issue that we can see then with the markets is because the way the Eurozone has worked and the way that's played out, unless we see anything that fundamentally changes how the Eurozone is moving, the markets tend to ignore it. And I think you'll almost, that's mainly because of the 2 years that we've had the Eurozone issue for. But of course, if this were to happen, then you're going to have that same sustained period where, unless anything changes, the markets, after their initial fall off the cliff, will then choose to ignore anything until someone decides they understand the issue, understands how to solve it, and we can do something about it. And with like the Eurozone, at the moment there is no one who knows how to solve it if we do tip over the edge. No, absolutely.
No. So that begs the question, maybe, with so much riding on the outcome of whether this can be offset, kicked down the road, or whatever. Is it the Eurozone crisis that has so far so absorbed people that the fiscal cliff has either been unthinkable or just distracted people's attention from it?
I think it's probably the token American in the group. I think we've just gotten numbed through the years. We know that it'll come time that the politicians will come together and kick the can down the road and just prolong the issue, I suppose. I don't think it's probably viewed as a disastrous scenario, because they'll inevitably, neither side wants that disaster to come about. So they'll vote through an extension and then they'll tackle it sometime next year, and it'll kind of keep going along in that perpetual cycle. Whereas I think the Eurozone, it's a lot harder to keep kicking that can down the road. I think some of the forces that we're up against are fairly imminent forces, and it's not a scenario where you can keep kicking and bailing out. And
also, I think it's about getting finances back on a long-term sustainable track in Europe. The fiscal cliff has nothing to do with the long-term sustainable finances of the US, and that's completely different. I mean, when Yannick was mentioning about bond markets, I think bond markets, bond yields have been declining for years. This isn't a new thing. They've just reached kind of, the zero bound, if you like. They've been reacting to debt accumulation in the US, and that's how I see the big difference between the two. Sorry, should I interrupt?
no, it's quite right. Good point.
So,
Can I add?
yes, John, go ahead, sorry.
Just about like the comparison between the Eurozone and the United States. I think just like in any other industry, I think the US is just significantly better in marketing. I don't think there's a big difference between the status of the Euro and the status of the United States. They're both mature economics coming to a halt, where in the United States their messaging and marketing is very clear from Washington. And in Europe, you're getting different interests of different countries, and you're hearing the Germans basically shouting out that everything is going to collapse because they're doing arbitrage on the interest rates. They're earning money when interest rates of Spain and Italy are going up and their interest rates are low. And I think this is something you simply don't see in the US, because in the US you don't see any internal, nobody's talking about the internal interest rates of the different states in the US and a default of a specific state in the US and their status. Where in Europe everybody's dealing with, whether it's Spain or Ireland or any other country.
Thank you, Yanni. That's a good point. And so really what we're just looking at is fiscal cliff being avoided at all costs. I mean, that would be, we are looking at an unthinkable scenario, are we here?
Really, really don't want to see that. And I think if you see the situation as well with China, so we've got Europe, now China is very much, I think, on people's radar, which is why this has been pushed sort of further out. So I think, the closer you get to the deadlines in the US, if we're continuing to see the background of China, slow growth, you really are going to have politicians focusing their mind, because if you have those three imploding simultaneously, then it really is.
And
It's going over the cliff.
we are absorbing some time on America, which is understandable and in a sense the key issue that we're focusing on here. But the intriguing thing is that America is actually further down the path of fiscal sustainability than perhaps what a lot of people recognise. That said, I'm not remotely trying to trivialise the incredible challenges, and the forward liability stream is still terrible and frightening. But at the same time, there is a consolidation going on both at the federal level and the state level, the state and local level, which not everyone perhaps sufficiently understands. For instance, in the past 7 quarters, federal spending in real terms has fallen in 6 of the 7 quarters. At the state and local level, it's fallen pretty much every quarter for the last 3 years. So there is consolidation going on, and the deficit as a percentage of GDP is declining. So it's happening. It's not happening as quickly as we'd like. At the same time, it's a bit like in this country. There's the right pace to go about these things in the context of there not being a whole lot of growth around, and at a time when deleveraging of balance sheets is very commonplace. Much the same falls in America, so it's a very tricky balancing act. And what we're really ultimately concerned about with the fiscal cliff is allowing the deficit to fall from 7.7 to 4% in 1 year is, I think we all consider too fast.
Yes.
So we're hoping that they go to 6, whatever the number is, somewhere close to 6.
Yeah, and I think the interesting point in this is how the markets have got such a short-term memory. And I think you go back 8 months, 9 months ago, the US was the shining light of the world in terms of economic recovery. The US was the way that we should all do it and the way that Europe should. And the markets were pleased with what the US was doing and so down on what Europe was doing. And I think things like this fiscal cliff, although everyone knew it was sitting there waiting at the end of the year, it's the way the markets just choose to ignore all these points. And again, exactly the same way with the Eurozone. I mean, we hear one piece of good news, we hear the ECB's plans, and the markets get shot in the arm. But we all know that the issue isn't solved. We all know it probably won't be solved, and we probably know that the ECB bond buying plan isn't going to be the thing to do that. And I think another interesting point is the elections. Is what an unwanted side issue the elections become for this, and whether it will help or whether it won't help in terms of putting things together. And as Michael said, the tax stance of Republicans of make this incredibly difficult to discuss, not only solve, but to discuss, and for anyone to become to be put on a level playing field with this and read from the same page, I think is incredibly difficult. And I think an interesting point would be if this actually ever comes up in presidential debates when we get closer to those times. And I think that election is just a real unwanted side issue that, of course, is massive for the country, but in the end, this is an issue that needs to be solved, and it doesn't need the political fighting that comes around an election.
Well, the election is a bit of an inconvenience in its own way, but
I think because the election cycle in the US is so short, because essentially they start campaigning 2 years before, it needs to be an independent body completely. But I think they've got the Congressional Budget Office to deal with things like Social Security, Medicaid and Medicare. They haven't touched those yet. They haven't done anything to reduce those spending, and that's where the key thing, that's where finances become unsustainable, 20, 30, 40 years out. I mean, I think, to add to your point, Michael, was that, what the US has that some countries in Europe doesn't have is actually, a fairly good birth rate and fairly good demographics in that sense, but it still has to cope with this kind of, we've got the fiscal cliff, and then we've got kind of this cliff of baby boomers who are retiring and expect things, and that's adding to this pressure, I think.
Yes.
Michael brought up a good point too on the possible debt downgrade. I think that would be a more painful cliff for America to fall off of than this fiscal cliff. I think that would be a disastrous scenario.
In real terms or physical terms or both?
Both, certainly in real terms, for sure, yeah. And I think, not to downplay it, but I don't see it as a scenario where if nothing got extended and we fell off the cliff in January, it's not the scenario where 600 billion of our money supply goes in the room and gets burnt. 80% of this is tax hikes, and the government knows how to spend and will spend it. So I don't necessarily see that being the doomsday scenario. I see if we don't show the rating agencies that we can start getting our arms around the fiscal deficit and start doing something to reduce it, they will downgrade it. And I think that's a further.
That's the more critical issue for investors, I think. But in a sense, the fiscal cliff is like is the preliminary round ahead of if you can at least get that done, maybe there's some hope that you will actually.
Yeah.
So I think
the long-term issue.
I think if this is prolonged and the compromise is overly done, I think that's going to lead to a dire state than if they take some of the medicine that we deserve as Americans. I've read some reports that say if we just jump off the cliff, cannonball, it would be 2 quarters of a recession, but it would have a $7 trillion effect on the long-term debt of the country. I think that's medicine we need to take. Yeah.
So what's good for the economy is bad for the markets. There is that element of it.
Sorry, if I could bring Yoni in on this one. What do you think about that, Yoni, as America taking its medicine?
Its medicine as Kiwi. I think Kiwi is almost like drugs, not only medicine. But I also think, referring to the elections just a couple of minutes ago, I think in general everybody understands that while the Republicans are much more pro-economy and theoretically would try to withhold the fiscal cliff, they are very pro-limited government spending. And today what's somewhat soothing the fiscal cliff is the fact that people are thinking about government helping the situation, where the Republicans, possibly Mitt Romney, will say leave it for the free markets. And I think if they would do so, we would be having a very interesting times in 2013.
So for a minute then, that will make the upcoming debates lively. It'll be the stupid economy rather than the economy stupid.
Absolutely, but I mean, I think this. As everybody said, I think minds will be focused. So the closer you get to things, the more you will be focused. We already saw previously when we had the threat of downgrades exactly what happened to the market. So they already had that wake-up call when S&P said, hello, look, this is what might happen. And we had a little taste then, in a very minor way, of the reactions of various markets and where they would go. And so I think people have something in that sense to really hang their hats on and decide, well, do we take the pain? Do we act? Do we actually, move on from here?
James, and from a trader's point of view, what are they looking at now over the next quarter as far as we discussed earlier about low volumes at the moment?
Yeah.
What impact will this have on the situation as we've seen it now?
Well, I think running up to something like this, it will be almost forgotten and put to the back of people's mind, I think, and much the same way that a lot of investors and traders think that the US politicians are doing. It will be, the deadline's not for a couple of months, we'll think about it then. And I think that's almost the way the markets have trained themselves to become. And I don't don't want to keep going back to the Eurozone, but the same thing has happened with the Eurozone. They've decided that we will only react when there actually something concrete happens, rather than all the political jostling and toing and froing. And I think that may be the same issue going forward. I think from a ratings agency point of view, the markets are very interesting, because I think it's just how much impact the rating agencies now have on the markets, because there's been so much intervention from ratings agencies that a lot of the time, again, markets and traders tend to brush not necessarily a downgrade off, and of course we think of a lot of this intervention from S&P and Moody's has all been within the Eurozone and stating the obvious, that we've downgraded Greece or downgraded Spain, and we all know that those situations are there. I mean, I think any more movements to downgrade anything in the US will be met with, of course, short-term panic, but I think that's the issue with the markets. Anything that we do see will be irrational market panic to start off with, and then we'll see exactly what Brendan said, that it's medicine that the economy can take.
Yeah.
Two courses of recession is fine if when you've got to run in and make a big difference going forward. And okay, we may get a short-term negativity to that in the markets, and that's probably understating it a little bit. But it's almost for the long term, things will seem a bit better. But of course, that doesn't help traders in long positions.
No. Michael, short-term market panic.
Well, one of the principal issues would be that if both of the other major rating agencies, were to downgrade America, is that has massive ramifications for investors because of the restrictions that they have in terms of they need to be in AAA rated investments, etc. And for a lot of them, they will be forced to look elsewhere. So initially there must be a negative reaction on the dollar, which could actually survive for the best part of 2 or 3 weeks while there's this sort of reweighting that goes on. And the beneficiaries would be those still very decently rated AAA sovereigns, of which there is a diminishing number.
Yeah.
And in that sense, being Australian and not necessarily being biased towards the use of Australian currency remotely, but one would imagine, all other things being equal, and we haven't really talked too much about China just yet, but all other things being equal, Australia being one of the better rated, if you like, superior AAA rated sovereigns, a currency like the Australian dollar would probably benefit quite a lot from an American downgrade if both of the other rating agencies were to go through with that. And the euro would, funnily enough, benefit as well.
I think the counterintuitive argument to that is that the dollar is still a safe haven currency, that the status is not going to change. So
this won't impact on the dollar as well as...
No, I think actually the dollar could do well through this, as running as that is. The first half of the year was horrible when it comes to volatility. Now we're starting to see a little bit of a pop, and I think all the uncertainty around the cliff and the elections and everything like that, the dollar could actually do pretty well, and these pullbacks we've seen in the year on the sterling could be good entry points. So I think gold, yen, dollar may do well through this uncertainty. And then as he was mentioning, once certainty comes into the picture, people start to get a realization of how this is going to play out, then it would probably be time to unwind those volatility plays. But for the time being, so I would say certainly for the next quarter into the new year, I actually think dollar's a good play.
Kathleen, dollar good play?
Well, we saw that back in August last year. The dollar did rally as the US was downgraded, treasuries rallied as well. I mean, it didn't seem to matter. Obviously, the S&P took about a 10% drop, I think, there or thereabouts. So, it does have impact on the US economy, but absolutely, I mean, there's nothing that has the liquidity of the US dollar. There's nothing that has the liquidity of the US Treasury. So I think if there is a downgrade, if there is a significant downgrade on the results of this fiscal cliff, I think that's going to be so interesting for actually what the investment community does. I mean, are they going to move into less liquid Australian treasuries or Norwegian government debt or something like that? I mean, these countries still do rely on kind of commodity flows, etc. They're still perceived as being riskier than or having their own risk, even if they are more highly rated.
Australia's an odd country in that it's the currency is the 4th most highly traded currency. At the same time as the economy is, I think it's 12th or 15th, I can't even remember, I should know this. 12th, 15th, somewhere of the order. So if you like, it sort of it bats well above where it ought to, which in a sense speaks to the domination of capital flows as being a massive driver of how the currency performs.
Do you think the government in Australia could get, even more antsy about kind of weighing the Aussie down in that case? Like if we were to see more of a long-term...
I mean, very recently we're starting to see the central bank governor talk, and some of the board members talk more openly about the currency being something that they're watching much more closely, and in particular the disconnect between how the currency is performing and how the terms of trade is evolving. Because just in the last few weeks there's been a significant decline in terms of trade in Australia, which is, and the terms of trade is a big driver on how the currency usually performs. And so to the extent that's not happened, it in a sense just reinforces the point that capital flows, and in particular these sort of what I call sovereign wealth fund flows and sort of safe haven flows in a sense, when it's coming into the dollar, into the Australian dollar, are really predominating. But diverting back to something Brendan said, I know I was sort of outlining the case for if the rating agencies do the dirty, then it's temporarily dollar negative. Personally, I'm particularly negative on the dollar for a number of reasons. One of them is I think that America is much more down the path of this sort of whole deleveraging theme, which will continue to be with us for at least the next 5 years. But America's further down the path.
In the sense of implementing policy or understanding the issue?
I'm talking about the whole economy. I'm not necessarily talking about the fiscal bit. The government bit of it is, if you like, the laggard. But in
The
terms
household
of, the household sector is doing a better job, and also the household sector's had the benefit of stocks going up more so than in Europe, etc. So the household sector is getting there much more than pretty much any other major advanced economy. Germany was never an issue with respect to this, but household sector's doing okay. Corporate sector's done very well, quite well, very very nicely cashed up. Government sector is kind of getting there, but perhaps not fast enough for all of us. And in particular, it's the forward liability strains that all frighten us as they should.
If I could bring Yoni in here, what do you think about that, Yoni?
Short or long term, is that the question?
I think that's
Short term, long term.
long term, Yoni.
Long term. So first of all, long term, we believe that March 2013 and onwards, we'll see maybe the dollar coming back. Until then, I think what we're actually seeing is monetary policy actually devaluing the dollar. So when you have a strong entity such as the Fed devaluing the dollar to increase exports, then it's hard to see how the dollar will significantly go high until at least elections are behind us, fiscal cliff either behind us or on top of us, and a bit of time to let the markets calm down and see whether the policy in the US actually led into growth.
Thank you, Yoni. James, we've heard a little bit about the Aussie dollar. What are your thoughts there? Would that be something that would interest you?
Yeah, and it's actually been, looking at trading volumes over the last couple of days from our point of view, the last few weeks, so the Aussie has been, you get this strange phenomenon of this risk on, risk off situation, which I don't always like the sound of, because you have we're very much in a risk on, or we're very much in a risk off place at the moment, and I don't really see how you define either of those ways at the moment. Of course, you have your safe haven plays, which are the old school safe haven plays, but how in the current climates, when you've got economies struggling all over the world, and the biggest issue for any economy, the number one barometer of all those being unemployment, none of those getting any better. I think for saying you've got, I'm into these more, I'm very risk off at the moment, I'm very risk on at the moment, I think it's a very, very dangerous way to play, because I don't think you can really change between those two. In terms of the Aussie, I think recently in terms of our trading volumes and things, and we were saying just before we started that this has been an incredibly sort of tough summer in this period, and we're running out of excuses as to why trading volumes aren't there anymore. But somewhere where the trading volumes have actually been there has been the Aussie, and so quite a lot of pushing towards the Aussie dollar, to be perfectly honest, just from a company point of view, looking to get people trading, saying let's have a look at the Aussie, and even using the sort of safe haven plays which wouldn't even necessarily usually be associated to that area. So I think it's somewhere, and definitely from the AAA rating point of view, where it does seem one of those more stable AAA rating countries. And in a time when you're looking for something safe and you're looking for AAA ratings, then the Aussie is an obvious choice there, because everyone else is staring over the edge of something, whether it be a fiscal cliff or a Eurozone capitulation or China completely falling apart as well. I think it's very hard to find positive news out there, I think, after time.
Catherine, what are you advising your clients at ForexSpace.com with the Aussie dollar?
Yeah, I mean, the Aussie's an interesting one, because I think sometimes it gets, it's given this view that maybe it is an alternative safe haven. I don't think it is, actually, because as we mentioned before, obviously its terms of trade are falling now. If the US was to fall into deep recession, that's going to hurt. At the same time that Europe is, that's going to hurt China so badly. We've already seen how sensitive the Australian economy is to China. If we see an erosion of say trade flows into Australia through kind of weakness in China, that is going to impact capital flows into Australia as well, because all of a sudden, the AAA is not looking as stable anymore. It's acting yet again as that commodity currency. So we've seen or certainly, maybe this time last year, or even just a bit before the concern about the US back in the summer last year. People were saying, maybe the Aussie can act as this safe haven. It absolutely didn't. It fell off the cliff itself. I'm always concerned about that. And the same with kind of the Norwegian and the Scandi currencies as well. Yes, they've got fantastic public finances. The liquidity isn't there, though. And I think during times of utter panic, you just go for your most liquid currency, and that's usually the dollar.
I think there's very few currencies which are in that situation now, where you can say, I no longer want to look at the US dollar as a safe haven, I'm going to try and find another one. And I think it's extremely difficult to find those currencies out there. No,
good finances and liquidity.
No, exactly. Those possibilities aren't there anymore. And I think it's really difficult for anyone. You see a lot of people talking about, well, we need to move away from the dollar being a safe haven currency, but where'd you go?
It's like FX trading during those periods becomes a great big compromise, I always think. So you have to compromise whether or not you want kind of the liquidity and to stick to what you're traditionally used to doing during times of market panic, which is, pile into the yen, pile into the franc, pile into the dollar.
Is that something you would concur with, Brandon, as our resident American?
Concur with which part? The Aussie dollar play?
And oil as oil and gold as the new safe havens.
Yeah, I think I would be short Australian dollar now, not because the economy is in a poor state. I think just to the contrary. I think specifically with the financial services sector, Australia is done in a far better place than most of the rest of the world. I think just because of what James was talking, the risk on off situation, I think the VIX is going to pop. I think it has to. And I think when that happens, the high yielders will drop, and the dollar will benefit, gold will benefit, yen will benefit. So that would be the medium-term play, I'd say. And then, also like you mentioned earlier, once the clarity comes to the scenarios of how this is going to play out, then you can start considering whether being long dollars is an appropriate move or not. I don't know what's going to happen with oil. It's tough to judge. I do see a pop in gold.
I don't see how gold can rally. Sorry to just the counter argument to that, because if we are, if we hit this kind of fiscal cliff and there's a real deflationary threat, especially in the US, I just can't see gold rallying.
Do you see a deflationary threat though?
Absolutely, yeah. I mean, if we have, if we were to have, the US plunged into recession for an unknown period of time, really, yeah, I do then at that stage, yeah, especially with falling oil prices.
And QE3 and everything else that's been done.
I don't think that's done too much.
QE1 and QE2 didn't do anything.
It didn't do too much for inflation expectations. I don't necessarily think, because we're in, and also because we're in a deleveraging environment, actually, globally. To me, that's by its nature quite deflationary, which should be negative for gold. It doesn't mean that there could be periods whereby, you know, short, sharp bursts where people do go into gold because that's kind of what they're hardwired to do. But I think as a long-term investment, I'm just a little bit more
I'm probably
concerned about gold.
I think a lot of people are quite concerned on the longer term, because if you look at something that's gone up for 11 years in a row, you know, ultimately.
And there's that as well.
There is that. You know, it is high. How high can you go? So I think kind of medium term, there is a view that given what's happening out there, that there is still that store of value in there. But I think longer term, obviously, there are quite a lot of question marks over there for a number of different reasons.
How about you, Johnny? Where are you on gold?
I'm long gold. First, long gold. I think we're seeing currency wars in action, and we see different countries fighting another fight, whether it's monetary policy, fiscal policy, whether it's the Eurozone crisis, the Japan crisis, the Asian crisis, and what gold doesn't have is a crisis behind it. And it's probably the only asset, hard asset, without a crisis behind it. And I think that will prove again and again as a safe haven. Again, gold is the virtual commodity that everybody respects. It's nothing else but perception. And when people are talking about fiscal cliff in the US, Eurozone in crisis, Japan, we all know where Japan is. And it's just, you know, when I look, I have here look at the table of long short of our traders. We have, I think, 85% long gold, and if compared to the Aussie, 55% short Aussie. So I think everybody's thinking gold is safer, and I think the average Joe around the world still really hasn't bought into gold. And with VIX going up, with volatility going up, with people all around the world understanding they can hardly rely on their currency, sometimes even, you know, to buy food if it's, you know, countries like Mexico and Thailand sometimes, then why not diversify into gold where it's so easy today? It's not 10 years ago, it's not 15 years ago. You can go to any of our companies, right, or here around the table, and buy gold for $100, for $500, or for $50,000. That simply didn't exist 10 years ago, and even today, it's a minority. So all of our traders are still, you know, a very small minority of the world's population, and that minority is gradually growing, and we'll see more people diversifying into different safe havens where gold and the black gold, you know, the oil, the black gold, are those safe havens.
Thank you, Jan. That's an interesting one. I mean, we've already mentioned China. Where are the Chinese on gold and oil? I mean, is that something?
Yeah. I mean, I think, I just want to go back to one thing that you only said today, the perception point. I think perception in the market is probably the strongest thing that anything has going for it at the moment. You look at gold, the perception of gold is that when times are tough, you buy it, you get into gold. It's been going up for 11 years on the back of it. So the same with the Aussie, the perception is the commodity-based currency. So commodities boom, you get a move to the Aussie dollar. And I think that perception side is what dominates the market. The same way we talk about the US dollar, it's that safe haven. Well, that's a whole perception thing. And like we're saying, that it's very hard to find any sort of safe haven. The one thing that keeps pushing us back into those areas is the perception that these things are these safe havens. I mean, in terms of China is is almost as worrying as anything else, because you have to look at the Eurozone from this point and how we're going to solve the Eurozone issue. If the Eurozone needs money, the place it goes cap in hand was to China, and they don't have any money to give anyone. So, I mean, I think that is a huge issue. I mean, you put everything together, it doesn't paint a very nice picture, and it comes back to the perception of all these things being the reason they boost. You've got the fiscal cliff, you've got the Eurozone, you've got China as really troubling the markets, so the whole perception thing comes back into it. That's why I'm going to trade, that's why I'm going to move into these things. okay, I can't find another safe haven, so the perception is the US dollar is a safe haven, so I'll go back into that again.
Right. You'd agree with that, Catherine?
Yeah, definitely. I think just with China, they can recover. You know, they still are kind of the world's factory, if you like, and you know, Europe and the US are the world's marketplace. So until their marketplaces recover, they can't, and that's what we're seeing now. We haven't seen that kind of shift in you know, global economies since kind of 2008 when people first started talking about it. It hasn't happened. I also think with China, the other thing to point is that they own so many treasuries along with Japan that, you know, if there is a big issue with kind of the fiscal cliff or you know, the safety of treasuries or they get downgraded, they're going to get hit very hard as well. And I don't quite have any idea what that would mean or what they would do, but I don't think it would be good news for them, and I think they're going to try very, very hard. There's probably a big lobbying effort going on from there to the rating agencies to say just hold your horses, don't do it.
What do you think about that?
Well, firstly, China and a number of other Asian central banks have been trying to diversify out of dollar risk for, you know, the last decade. I mean, I can recall some conversations I had a decade ago, and they were talking about it then, and indeed a lot of major central banks were talking about it, and that shift in a sense has been happening. And
into
they
the euro
remain,
or
it certainly initially was into the euro
Now
for
it is.
quite a number of years. In the last 2 years, those sovereign wealth funds, you know, the dollar, we've been trying to get out of the dollar, but the euro looks even worse. So where do I go? Well, the Aussie is really tiny, the Norwegian krone is even tinier. Sterling, you know, gosh, who wants to invest in Britain? You know, the yen, well, you know, we're worried about government debt, but it's 200%, and they've had an earthquake and a tsunami, and a lot of their industrial capacity was knocked out, and it's, you know, the least bad, which is the least bad.
How about some of the Latin American countries? Mexican peso?
You know, Mexican peso ultimately is driven by the oil price, and you don't have the liquidity in the peso, you don't have corporate governance that you'd ever really be confident on in Mexico, you know, et cetera, et cetera. You know, you'll be more familiar with Mexico than I would be, I'm sure. Just getting back to China, China also obviously, you know, we talk about America's presidential election. Well, China at exactly the same time is pretty much having the transfer of its political power, and that has been, as I'm sure most of us could appreciate, has been incredibly tumultuous over the course of this year, and still looks as though there's a lot of machinations going on in the background. But again, none of us could ever pretend to know really what's happening behind the scenes. But there is a large transfer of power going on, and it is not clear what's going to happen out the other side. And as a result, Chinese policy making over recent months has fallen into a bit of a void at a time when China really desperately has needed more in terms of stimulatory measures to try to underpin their economy, because their economy this year has really changed from being a high growth economy to what will be over coming years nothing better than a medium growth economy. You know, their underlying growth rate now has shifted irreversibly. Yes, and that's
Why do you say irreversibly?
they can't get back their internal finances are dreadful. When you look at their balance sheets across the major sectors, and in particular sort of in the government sector and the finance sector, are in terrible shape. Bad loans amongst China's major banks in the first 6 months of this year rose more than 3 times relative to the end of last year. Non-performing loans in China will become a very big issue over, and is already a big issue over coming quarters. So China does not have the financial wherewithal, and you know that there's a problem in China because the expat money is flooding out.
So where do we go from here then? Up until the, say, the end of this year, there's going to be a lame duck presidency. The new incumbent won't take over until the 20th of January. So, James, starting with you maybe, what are you advising your clients as far as trading for the next quarter?
it's an interesting thing. A number of the polls go around sort of this time of year to say, so what are we expecting up until the end of the year, and what are we expecting the first quarter of next year? And we do this around the dealing desk, and we do it around the analysts, and the mixture of results in that was ridiculous. And I think that points to the fact that either at Alpari we're just all clueless, or there is just so much uncertainty around that it's very hard to actually pinpoint where we're going to be. And I personally think running up to the end of the year, I don't see too many huge movements in major equity markets in many of the major currencies either, because there are these huge issues that nothing will be done with until those points. Now, the fiscal cliff, there may be an issue where we get to a point where we'll jostle around a bit, and 1 week we'll be saying nothing's going to be done, and then the next week we'll be saying something's going to be done. So I'm not saying the volatility won't be there. I think the net movement will be nothing. I think there will be big movement because, as Michael said earlier, eventually we know that this will get sorted out. That we can't they won't let the US drop over this, despite it maybe being the right medicine. I don't think it will be the case that they do take the medicine, even though it will maybe in the long term be a positive thing. So I think there will be volatility, but I think fundamentally I don't think we will necessarily go very far.
No. What are you, Kathleen? What are you seeing as some good trading advice for your clients?
Well, I mean, we think we've got quite toppy, especially in kind of stocks, most definitely. We'd certainly be sellers of oil if it got back to kind of, one Brent, talking about Brent here, if it got back to kind of, the 112, 115-ish area. And we think that it could actually be kind of a quarter almost of two halves, whereby you get kind of a sell-off coming back, but then if everything is sorted out regarding this fiscal cliff, then you start seeing kind of risk go back up. In terms of the euro, I think, we're seeing short, sharp sell-offs, but our clients are still very interested in the euro and what's going on there, and they believe, and so do we actually, that the tail risk has gone now of the eurozone collapsing. We just need to get Spain to kind of actually apply for a bailout, and then that will cause another bit of a rally and
Yes,
exactly.
Except their medicine.
I think Obama will win. I think as the campaign chugged along, that becomes more and more inevitable, it seems, and Romney steps on his own words. And I think he's got a more pragmatic approach to the cliff, and while Romney wants to extend the Bush tax cuts altogether, he wants to extend them but just for the middle class. I think that's a more pragmatic approach to doing it. So I think the uncertainty and then the actual approach to kicking the can down the road, but in a more responsible way, I'd say, is strong for the dollar. So right now, for the short term, I'm long dollar and Japanese yen. I think, not to divert the topic, but I think we talked a lot about the world looking for the next safe haven, and what's going to emerge is that. 5 years ago, I don't even think that was a topic of debate. I think that the euro was on a default path to eventually become a safe haven currency. And as Michael mentioned, China was filing into euro bonds, and all looked well and good. I think a worthwhile debate is, would it still be on that path without the pigs? I think this would be a different conversation if, when the eurozone was set up, there was an exit clause or escape route, so that countries could be forced out, could opt out, or whatever the case is. The euro could move forward on its clean and clear path. And I think we have that default go-to right by now if that had been the case.
And Yoni, what are you hearing from your clients, and what are you advising them with regard to the next quarter?
We're advising them what everybody here should advise them. Be in the markets. Make sure you're in the markets. Make sure you're trading. Because if you're in euro, there's a good chance the euro will collapse. If you're in the US, there's a good chance for a fiscal cliff. And if you're in Asia, there's a good chance for a recession there. So wherever you are, you need to make sure you're well diversified into the global markets. You have a good balanced asset allocation between the top currencies, some developing countries' currencies, and the hard assets, gold, oil. And of course, everybody should look at the rally in the equities market. We've been pushing the rally in the equities market. I think there might be a small correction in the next couple of weeks, but all in all, we'll see 2012 ending with a very positive note in the markets, which is actually very surprising. And again, the most important thing is for people, to shake off the fear and make sure they have a good, solid, global, diversified portfolio across all assets and be active to know how to balance it, because whatever we say now, I always say that to Lior, whatever we say might change in a week when something new happens that we didn't expect. And these new black swans are appearing on a weekly basis recently on CNN.
Do you see any new black swans on the horizon coming?
Well, I mean, I think if I did, I might not be here. I think it's certainly true. I mean, something else will come left field, because it always does, and we've had that over the last couple of years of things coming out of nowhere. I'm not sure that I would perhaps be quite as negative as, recession, definite recessions and definite cliffs and definite collapse of the euro. I think it's true. One of the key things that we've all talked about is perception and mood, and the market has inevitably been driven by that and will continue to be driven by that. And if it can shake off some of the whole fear and the negativity thing, then it will definitely be a brighter trading future for everybody.
Michael, are you seeing your clients shaking off fear?
Firstly, appreciate that the market is still structurally short euros. We're not just talking here about traders, we're also in particular talking about investors relative to where they'd like to be. Now, that's been deliberate on their part, for very good reason, for all the reasons that a number of us have discussed in this past hour. It is conceivable that we might see the euro creep a bit higher over the next 6 to 8 weeks, because this is traditionally the period where both trading books and investors are conscious of, at least with respect to traders, diminishing their risk books and cleaning up their risk books, reducing their risk coming into their financial year end for a lot of them, not all of them. And for investors, making sure that their allocations across currencies is where they want it to be for the end of the year. So with that in mind, there's the potential for the euro to be what I call a buy on weakness, or to have that feeling of a buy on weakness rather than a sell on strength. At the same time, unlike Brendan, I have I'm probably talking about a longer time frame here. I'm not particularly averse to the dollar at all. I see a number of reasons why the dollar is going to be okay. Even if there's a downgrade, yes, it could hurt for a couple of weeks, but ultimately I see the dollar as still being pretty much centre of what's going on, and I do see a resolution. So, and James's observation that there'll be volatility over coming weeks, but generally not big moves. That's kind of one I like as well. I like that idea that you're more sort of looking to sort of pick ranges rather than trends. And the Aussie, for instance, is the Aussie here, but the Australian dollar is a classic one. I think there's a range of roughly parity to about 106, and what we've been finding recently is 106 has been very hard to break on the top side, and there's buying underneath parity, or below, just above parity. So the likes of the euro and etc. It wouldn't surprise me to see the euro get to 133 before the end of the year, and maybe finish the year 130, 131. That would not be surprising. I'd be quite surprised, very surprised, if the euro got down to 125 before the end of the year. And if we ever touched it, I'd be very surprised.
Yeah, I mean that's kind of what I've said. We think the tail risk is gone now, and actually, if anything, if the focus shifts from Europe to the US, actually I see that as being quite euro negative, because I think that would be dollar positive, because I think that would be a risk-off event for markets.
James?
Yeah, definitely. I agree that the risk-off event side. I think that would definitely play those ways. I mean, I think in terms of a lot of what Michael said earlier about who wants to invest in the UK, and that's a key one that we've been talking to clients about as well, and how they play the pound, and it's usually, we talk about so many other things, and then when it comes to the pound, everyone goes a little bit sheepish. And I think that's still a play to keep on.
But it hasn't harmed it in any way, you know. So
no, that's true. I mean, we're still trading around this 161 sort of level, which again, like everything else, I don't see going away that far, to be perfectly honest. So no one likes to talk about it, no one wants to invest in it, but it still stays pretty steady where it is. Maybe there's your other safe haven. Probably not.
Yes, John, I was going to bring you in on that one. So carry on.
87% of our basically exposure on the pound dollar right now is short. And we usually are in the range of 40 to 70 on most assets. When I see 90% short on something, it usually means something is about to happen. And I think my point before was not hysteria or whether pro price is going to collapse or the United States is going to fall into a recession or any other alternative. It's that something is going to happen, and people usually forget that something is happening. So there's a crisis around the corner. I think the real movement is talking about it very well. We just don't know exactly what the crisis is.
Thank you, Yanni. Well, that seems like a good sort of statement to wrap up with, in actual fact. I was going to say that the subtitle of today's roundtable was "Prepare for the worst and hope for the best," and I think that's what Yanni's sort of saying in his own way. So I'd just like to thank you all for coming along and participating.
Thank you.
And look forward to our next one.
Yeah.
Thank you very much.
Okay.